Gold is closing in on $4,700. Bitcoin is back above $80,000. Two completely different assets, moving higher at the same time. But here's what makes this move so unusual. PCE inflation is still running at 3.7%. The 30-year Treasury yield recently hit 5.34%. Rates are high. Inflation is sticky. The dollar hasn't simply collapsed, and yet investors keep buying gold. They keep buying Bitcoin. Then, right as the bond market came under pressure and America's long-term borrowing costs surged, the U.S. Treasury doubled its bond buybacks. That's when this story became much bigger than gold at $4,700 or Bitcoin at $80,000. The market may no longer be trading just one question. What will the Fed do next? It may be starting to trade a much bigger one. What happens to America's $40 trillion debt problem? For years, one Fed headline could send gold surging or crashing. But does the Federal Reserve still control gold the way it used to? The answer may be sitting right in front of us. In the U.S. Treasury market, the 30-year Treasury yield recently surged to around 5.34%. The United States now carries more than $40 trillion in federal debt. When a government carries that much debt, the question changes. At what cost can America keep refinancing an ever-growing mountain of debt? And the government isn't the only borrower competing for capital. AI is creating another enormous demand for long-term funding. Data centers, power infrastructure, and semiconductor supply chains all need massive investment. Everyone is competing for the same pool of long-term money. When supply of debt rises while demand for capital explodes, investors demand higher returns. That's why the move that may really be getting out of control isn't just gold. It's America's cost of capital. Then the Treasury stepped in. Treasury Secretary Scott Bessent announced that the size of certain buybacks in 10 to 30-year treasuries would increase to at least $4 billion per operation. This is not key. The Treasury is not simply printing money. The official purpose is to improve liquidity and market functioning. Why increase long bond buybacks just as long-term borrowing costs were reaching extreme levels? That's the signal markets care about. Buybacks can ease short-term pressure. What they cannot do is make the underlying structural problems disappear. The fiscal deficit is still there. And this is where gold and Bitcoin entered the same macro story. As long-term yields pulled back and the dollar weakened, gold remained heavily bid. The debasement trade. That does not mean the dollar is about to collapse. The argument is more subtle, focusing on purchasing power and debt. If the entire adjustment cannot happen through higher interest rates, does it show up through a weaker currency or a higher risk premium? For years, the gold playbook was straightforward. Hawkish Fed means gold down. Dovish Fed means gold up. But lately, that relationship has cracked. Gold surged while Treasury yields were still elevated. Gold is rallying in an environment that should normally be hostile to it. Then came PCE headline, inflation at 3.7%. Markets responded. Expectations for a more hawkish Fed increased. Treasury yields moved higher, and gold got hit. The Fed absolutely still matters for gold. Inflation changes rate expectations. Rate expectations move Treasury yields and the dollar, and gold reacts. But what happened after the sell-off is much more interesting. Gold didn't collapse. During the Asian session, price moved back above $4,600. Gold may now be trading on two frameworks. One, the Fed and inflation. The second, fiscal deficits, debt, and confidence in the dollar. Bitcoin has pushed back above $80,000. The rally has been linked to a softer dollar and debasement fears, but we need to be careful. Gold is a traditional reserve asset. Bitcoin is a much higher beta asset. Its price is influenced by ETF flows and liquidation dynamics. Investors are increasing exposure to scarce assets outside traditional sovereign liabilities. Gold is the established version. Bitcoin is the volatile version. U.S. technology stocks were under pressure, but Nvidia's earnings helped restore risk appetite. This is more complicated than a risk-off trade. The Treasury fears the cost of financing. The Fed fears inflation. Imagine what happens if that tension gets worse. The Fed is still powerful, but it may be losing its near monopoly over the gold narrative. 3 things to watch: yields, the Treasury, and Kevin Warsh. If you want to follow this story, subscribe to Grand Markets. Tell me in the comments, which does America choose? Higher rates or a weaker dollar?